Hi, my name is Sandra Bailey. I am the owner and founder of Women Financial Power, and I'm also a manager and business partner with the Executive Strategies Group. So today, you guys requested a copy of a recording because you wanted to know more about the Index Universal Life Policy. So there's a lot of stuff in this presentation that I will be skipping over, but once you schedule your appointment, then we can go over it more in detail because I'm trying to make this only about 15 minutes or less if I can, trying not to talk a lot. So let's get started. So what we do at Women Financial Power, we want to achieve 3 goals with each of our clients: retirement income plan, a long-term care protection plan, and a legacy plan. Our value proposition is that the retirement plans that are being used, that we use, are the same plans that's used by executives, college coaches, and wealthy individuals, high net worth individuals. These plans, non-qualified, are safe. They do not put your money at risk. They generate more income. Usually for the average individual, they'll generate about 25 to 30% more income than your qualified plans. And finally, there's no cap on the contribution limits. If you are a high net worth individual or you make over a certain amount of money, married or single, you know there's a cap on how much you can contribute to your Roth and to your 401k. So when you retire, there is going to be a retirement income gap. So these plans help fill in the gap as well. Now, Congress established 2 retirement systems in America. They established the qualified plans. They used to be pension plans back in the day, which a lot of people stopped doing it. But in 1980 is when the retirement plans came in, like the 401k. Now, 401ks wasn't meant to be a retirement plan. They were basically just for wealthy people to shield their some taxes. But now companies aren't offering. Okay, I'm talking too much again. So then there's non-qualified plans. Now, non-qualified plans have been around since 1940s. And you can look at all the different types of non-qualified plans in here, okay? Now, if you want to find out more information on non-qualified plans, you can go to mynqdc.com. There's a lot of information out there for you. I put this W-2 in here because right here under box 11 is non-qualified plans. And we probably just didn't even notice it. Your qualified plans are normally over here, but non-qualified is on your W-2. Now, the vehicle that you're interested in, the Index Universal Life, it says use the same investment vehicle used by large corporations. So if you click on some of these links, you can go right to the article. This says where region CEO salary ranks. So what's interesting to me about this article, it talks about all the money that he earned, 1.4 million in 2014. But the bulk of his money is in non-qualified deferred compensation, $6 million. He don't have that much in any of his other stocks or incentives or anything, but he has $6 million in a non-qualified deferred compensation package. So now we want to see where do the funding, how these executives fund their policies. COLI stands for corporate-owned life insurance. So 73% are using this for their non-qualified deferred comp. 82% is using it for their supplement employee retirement plans or their defined benefit plans. Very interesting. 7 in 10 business owners use life insurance to fund their non-qualified compensation packages, and you can too. So this is very interesting because it talks about variable, whole, and universal life plans are what they use to fund their retirement plans. So these are permanent life insurance plans, not term. You have to use permanent to fund these plans. Now, I do have another presentation that just talks about different types of life insurance, but here we're not talking about that. Permanent life insurance is used to fund these corporate-owned life insurance plans. So we go here and look at here. Cash value life insurance makes Harbaugh college football's top paid coach. And so the part on here that's very interesting to me, it says this type of deferred compensation alternative appeals to talented leaders and executives. All you hear about is executives, So what most people don't know, however, is that the compensation strategy was designed to provide Harbaugh with millions of dollars of tax-free cash during retirement is one that can also be incredibly effective on a much smaller scale. So we know Coach Harbaugh makes $7 million, is public knowledge, right? And he's putting $2 million a year for 7 years into his cash value life insurance policy. But you can do it on a much smaller scale. It's out there and it's available to everyone. So we talked about the permanent insurance, right? The different types, variable, whole life, universal. So this article is a Forbes magazine article, how to use life insurance in your retirement. I thought this was neat, the little black book of billionaire secrets. But anyway, investing in the market without taking losses. Is it too good to be true? Well, not according to Harbaugh. According to USA Today, he showed that his deferred compensation package utilizes cash value life insurance called Index Universal Life Insurance, IULs. So IULs appeal to many executives, there's a word again, and business owners because of the advantages they provide. IULs allow cash value within the policy to grow tax-free over time. IULs are funded with post-tax dollars, which allow clients to withdraw money tax-free at any age and provide financial security in the form of a death benefit for the family member after they pass away. So this is when you heard the term be your own banker, because you can withdraw the money tax-free at any age and you pay yourself back, okay? So what is an index universal life policy? It's built around two concepts. The first concept is index interest. So index interest, an index is like, what's the word I'm thinking about? I'm sorry, my phone is ringing. I'm so sorry. So index is like an S&P 500. That is 500 indexes. All right, and they call it the S&P 500. That's the one most people are familiar with. And then the banking concept of leveraging is called arbitrage. So arbitrage, try to do this very quickly, is getting paid interest on money, making interest on money, and getting paid interest on the same money. So if you put $100,000 in the bank, then the bank can loan that to 9 people. So if you have $100,000 in the bank, you will get paid 1% interest, probably less than that, okay? Then if another person borrow $50,000 or $100,000, they're going to pay a higher interest, say 4%. So you're getting paid 1%. The person borrowing the money is paying 4%. So the bank is making 3 off of your money, right? So that's considered arbitrage. So with an index universal life policy, you can be your own banker. You can make interest and then you can pay it when you have a loan, but the money difference goes back to you. That's pretty awesome. Okay, we talked about this. Interest is credited. No money is invested. It's just credited. So it's not invested in the stock market. They use, almost all the companies use the S&P, and some of them have their own indexes. You'll hear terms like cap, participation rate, or spread. Though a cap is the max they'll pay in an index. A participation rate is a percentage of the index that they will pay. And then you may see a spread. So I think I have some examples in here. Oh, and then with a minimum of 0%. So 0 is your hero. If the market goes down, you'll just be left at 0. So I'm gonna give you a quick math question. I want you to give me an answer when we meet. So if you had $100 in the stock market and the stock market dropped 50%, how much money do you have? You have $100, the market dropped 50%. What's your balance in your portfolio now? Then next year, the stock market goes back up 50%. So all the brokers would say there's 100% return, but how much is in your portfolio? Once again, $100 in the stock market drops 50%. How much do you have? The next year it goes back up 50%. Now, how much do you have your imbalance in your portfolio? I would like you to tell me how much you had if you was in the stock market and how much you would have if you was in an index universal life policy. Okay, so tell me that on our visit. Now, here's just some more indexes. Fidelity, S&P, so you have a spread. A spread is a difference. So if the stock market went up 10% and there was a 3% spread, you make 7. What I want you to see here, in 2008, the S&P was down 38.5%. A lot of people lost a whole lot of money. But if you had an indexing strategy like this plan, whatever you had accumulated in that policy, you would have made 0, meaning you would not lost any money. Hint, hint to the math question. Okay, and then we're not going to talk about this. These are just some of the indexes and the max rate. They could have returned more, but the companies won't let you illustrate more. They have an average that you can illustrate. We can talk about that later. And this is your arbitrage. So you are your own banker. Now, I just looked this up on the 27th, and these are real numbers because I had a client come over and take a loan from their policy, being their own banker. Instead of going to the bank, they took a loan from their own policy. So the average rate that we looked at was 6.1%. That's the average rate. It could go higher. In the particular situation that I'm talking about, his average rate was 5.89. But what he made last year was 12 point something. That's awesome. The maximum loan rate on the monies you borrow with this particular company is 6%. That's the max is 6%. So when you sign an application and you get a life insurance policy, that is a contract. So if it says 6% in your contract, then it will stay 6% as long as you keep it. So if you look at the future and interest rate may be back double digits at 10 or 12 or 18, like we have seen in the past, and you have this contract, your loan rate would never go above 6%. Okay. But with this particular plan, the current variable loan rate is only 3%. So when he came to get a loan, his average was 6 and his loan is going to be 3. So all that is going to go back into his pocket. So he's his own banker. So that's pretty cool. Okay, it says move along. So there's only 4 places where your money is safe. So let's talk about it. First one is in a cookie jar under your mattress in the backyard, right? The next one is a bank. We know we don't make any money in the bank. So if you have a lot of money sitting in the bank, it's just sitting there. It's safe, but you're not making anything. Inflation was 7.9 and you're making 1% on your bank and your money in the bank. So you do the math. You're basically losing money. And then we have government treasury bills and bonds. They're safe, but the interest rates go up, bond rates go down. And of course, we have life insurance where your money is safe. This is a recap if you want to stop and read that. Now this one, I'm going to take a little bit of time, maybe a minute. I'm going to try to speed through it because I don't want to be over 15 minutes. So this is a 35-year-old female, Tennessee standard non-tobacco. These plans are purchased based on your health. The healthier you are, the better rate you get. If you do have some health conditions, it's okay, call. I am a broker, so I shop different companies and we can probably find you a rate. Or a company that may write you, but don't give up. If you have health conditions, just call me anyway or set an appointment. So this 35-year-old is contributing to 67 for retirement. They're using $1,000 a month. So if you did the math, I use FINRA savings calculator online, 6% net rate of return, didn't include any taxes. There is market risk to this plan. And what was the last one? Losing my mind right now and trying to go too fast. But there's no fees. I did not put any fees in here whatsoever. And you know your 401k plan does have fees. So the experts say once you retire and you have a lump sum of money. So in this situation, it's like 1.156 million. So you could take 4% of what you save to say how much you would have in retirement. And they say it would probably last you 25 to 30 years, not guaranteed, but it probably will last you 25 and 30 years. There's no guarantee. So 4% of that 1.156 is $46,000 a year that you could get from saving $1 million. And you have to subtract taxes from that. You have to pay taxes on the money because it's a qualified plan. So you have to pay taxes on it. And when you pass away, whatever you leave to your beneficiary, it's going to be taxed, okay? So let's take the same scenario and look at an executive insurance plan. You may have heard the term LIRP, that's life insurance and retirement plan. You may have heard IUL, that's indexed universal life. And you also may have heard about a plan 7702. 7702 is just the IRS rule that some people are calling this plan, but it's the IRS rule that says you can take money out of your life insurance policy as a loan and you don't pay taxes on it. So that's what everybody's doing. So if you had this plan, as soon as you got approved and put your policy in force, you got $639,000 death benefit. If something happened to you, your family would get that. Your income that you would get at age 67 is $108,000 a year. That's income tax free, no market risk. At age 67, your death benefit is 1.168. So you have a death benefit, you have income coming in, and it's going to last until you pass away. Now, the last thing we talked about was long-term care. So these policies also include coverage for long-term care. Chronic illness is considered long-term care. They include terminal, critical, and you can also get these benefits added on if you choose to. Now, your homework that I would like for you to do is go to Netflix. If you click on here, this is a trailer. It's called Money Explained. There's only 5 episodes, less than 30 minutes each. So take some time and watch that. You'll be glad that you did. I sound like I'm in church something. And then you have a PBS documentary, Frontline, called The Retirement Gamble. It is a documentary, so it's pretty long, but I think it would be very educational if you took time to watch it. If you want to set another appointment, you can go to Let's Talk or speak to an advisor here, and you'll get right on the calendar. You can schedule an appointment. If you go here and do ready to get started, one of our advisors will give you a call back when we are available. When we do call you, be ready to give us some confidential information, because since this is life insurance that we're using to fund your plan or help you be your own banker, we'll have to know some personal information. It's strictly confidential. And then finally, you can follow us on social media. This is on YouTube, of course. So like it and please subscribe. And thank you so much for requesting and recording. Kept it under almost 17 minutes. Okay. Somebody's talking in the background.